Hi, this is Joe Rabil with Invest Like a Pro. I'm going to continue to do analysis on the S&P, and I'm actually going to add some other things over time, maybe the oil market, different things, gold, that type of thing. But I'm not going to do it every time right now. If the S&P starts to get more active, then I'll definitely bring it in on every single video. This time, I wanted to answer some questions that I've been getting related to the tools that I use. I'm going to spend some time talking about my entry triggers in a little bit more detail, but more important than anything, I think I wanted to spend some time looking at what it takes to be, what I believe it takes to be successful trading, and also sort of the difference between trading and analysis. So let's get into the charting package that I use. For one is AmiBroker. That's this package here with the 4 charts right now. I actually spread it out over 2 or 3 monitors. I've got different charts all over the place. So when I use this this specific program, it's a very powerful program. The only thing about it is you have to understand that you have to get data from somewhere else. You can get it from Yahoo for free, but that's more end of day. You can get it from TC2000, which is another program that I use. And then I actually use eSignal as well, and the data, you can get live data coming through. There's a lot of different options for AmiBroker in terms of the data. I think it's a very good program. It's fairly inexpensive. But it gives you a lot of flexibility, and I've been using it for a very, very long time, so I would definitely recommend it. It's just you have to understand you have to get your data from somewhere else. TC2000 is a program that I believe is very, very useful for the average investor. You can go through on the left side. I've got all the different lists and screens that I run. It's very, very easy to run individual screens. I can go through and pull up stocks that are passing a specific screen, and then hit the space bar and browse through the list very, very quickly and try and identify the stocks that I like to look for. I found this to be a very, very powerful program. It has helped a tremendous amount, relatively cheap. It's not totally inexpensive, but I think for what you can get out of it, I think it's well worth it. And just to go into a little bit of detail on what the specific tools that I'm using, I like to look at an 18 MA, simple MA with a 40 simple MA, and I have that on every single one of my charts. I also like to look at MACD, the standard MACD with a 1226 and then a 9 exponential moving average of that's the signal line. So I'm using the standard version, the one that typically comes in a software package, 1226.9 for MACD, and those are exponential moving averages that are being used. For ADX, I don't use the standard version. I use a 13 for the DI lines, and then the smoothing, I use an 8. I do that specifically because I'm trying to find, I want to see more valleys, peaks and valleys in the ADX line. And I think it helps to really compare the strength of one move versus another. When it comes down to ADX versus the MACD, I did a whole video on this, but to put it in a nutshell, MACD is based on the close and ADX is based on the range. And so they complement each other very, very well. I tend to use the ADX to identify which stocks I want to trade, and I tend to use the MACD to help me identify the timing or improve the timing or help me with the trigger of an entry. So that's generally speaking, it's not 100%, but generally speaking, how I use those two indicators. Those are the 2 main indicators. I do use RSI. At some point at a later date, I'm going to show you a really neat way to use RSI, a very powerful tool. But for now, I'm going to stay focused on the 4 quadrant, monthly, weekly, daily, hourly, and at 18 and 40 moving averages, MACD, and ADX. Those are core things. If you understand these 4 things, I think you're going to learn. I think you're going to have the tools that you need to be successful in looking at things, at least in the way that I'm looking at them right now. When it comes to trading, I think you have to understand something. you can do all the analysis that you want, but it's not really about being right. I mean, it sounds so ridiculous, but everyone wants to be right. They want to be, they want to pick a low, they want to pick a top, and they want to go and tell everyone, hey, I picked the low in the stock or whatever. Professional traders, that is not what they do. They look for an edge in the market. They want something that is going to provide them. Basically, the way Don puts it, Don Miller is a very, very successful S&P futures trader, and the way he puts it is he wants to flip a weighted coin that's going to come up heads a little bit more often than tails, and take advantage of that. That's your edge in the marketplace, and just continue to just put that in play and work it into the ground to create consistent profits. I think a better way of understanding this is if you look at the way Bruce Lee describes how he looks at being successful in terms of learning a specific move. He's saying that he's not afraid of a guy that practices 10,000 kicks one time. But he is afraid of the guy that's going to practice one kick 10,000 times. And the way I would put that in terms of trading verbiage is that you want to learn one method, one strategy in the market, and learn it very, very well. Learn it inside and out. And if you do that, I think you're going to be a lot more successful than the guy that has 20 different approaches to the market, but he's not good at any of them. So that's how I would recommend looking at this. And what we're going to do is we're going to go through a few different criteria that I think are really important to be successful as a trader. I think you have to have the method in place. I'm going to go through some of the things that I think are very important about the method, but I also think you have to have the mindset, and that's some of the mindset takes place a little bit later out of these criteria. But the first thing is finding a similar pattern setup on a higher time frame. So if I want to think about it in these terms, I'm looking at something like the Chewy setup that I mentioned a few weeks ago. Really strong, powerful move to the upside where you see the arrow pointing to the upside, and then we're looking for a pullback off of that. And the same thing held true in the Peloton. You had a really strong move to the upside, and then you look for the pullback. The thing is where the arrow is pointing here, and you're in the uptrend, there's a lot of different choices at this point. And I think you need to go through and look at it like a tiger would. Here are all the stock, the tiger is basically looking at all the different stocks he could choose. And he's stalking it. He's not chasing after anything. He's going to wait for one to get all by itself and look weak and look like he can pounce right on it. And what that means in terms of looking at it from a stock market standpoint is we want to go to number 2, which is waiting for a counter trend move to develop on the lower time frame. And so if I go back to the same stocks, I'm looking for the counter trend move. That's where the 18 crosses down below the 40. And in both stocks, you can see these patterns. They look very, very similar where the 18 crosses down below the 40. And if you notice what takes place in both cases, price goes in between the 18 and the 40 and then tries to continue to the downside. If you were in a bearish trend, you should have just continued to go to the downside and move to the direction of where these moving averages are. I mean, a crossover to the downside is supposed to be a negative situation. But the reality is that because the higher time frame is going in the opposite direction, we're looking at the opposing trend and waiting for it to fail. So in this instance, there's 3 or 4 different ways where we can look for triggers to develop. So if I look at one example would be a zero line reversal where the MACD crosses up around the zero line. And in this case, you always use a trend line as a trigger. The reason why is because the zero line, if you on a pullback, if you hold the zero line, you're showing a lot of strength in the trend. It's telling you that there's a lot of power behind it. If you can hold the zero line on a pullback, you're probably just going to continue without a whole lot of fanfare. The second option on the right, the top right, is basically where you go, the 18 crosses down below the 40, but then price goes into the zone and then comes out of the zone, but doesn't go to a new low. So it looks like it wants to break down and continue to fall further, but it doesn't, and it reverses and turns back to the upside. So you can use a number of different criteria for this trigger. It could be breaking back above the 40. It could be getting back above the 18, depending on the situation. If we go down to the bottom left, another example would be where the 18 crosses down below the 40, but instead of going in the zone and out of the zone, it just goes straight up through both moving averages. In this case, I would buy a pullback. And if you notice, if you drew a downtrend line, you'd have the 1 as the break of the trend, and then the 2 would be the pullback. And that would be this first pullback in a new forming uptrend. So this is a third example. These are all variations of the same pattern when you look at it this way. The fourth one is actually you go in the zone, you have the crossover to the downside, you go in the zone, and instead of failing, it actually goes to a new low. In this case, we know the short-term trend is a little bit weaker. This is the trigger trend, and it is to the downside. So we want to wait for more confirmation. We want it to break the trend line. We want to get back above the moving averages and then look to buy the first pullback, or even wait for the 3 to take place and make it break out above this prior peak if you want a little bit more confirmation. I just wanted to give you a little bit more detail. I didn't go into too much depth, but I want you to understand these are just 4 examples of what really is a lot of small little nuances that come into play when you're looking at the different triggers that can take place. So I'm saying 3 to 4 different trigger patterns, but the reality is there's variations of each one of these. And I think the more time you spend looking at this pattern and looking at the 18 and the 40 and just understand the concept and always go back to the 1, 2, 3 change in trend. And I think if you know that, I think you can be very successful finding the right times. But realize this, you're never going to be 100%. Even if you get all of these triggers and understand them completely, you're going to get in and take losses. It's a part of the game. If you're not willing to do that, then you're not going to be successful trading. If we go to number 4, one thing I think is incredibly important is you can do everything right and then a stock could gap up, or it just might not trigger properly. It might not pull back. It might just go and just keep going. And you have to accept that. You're not going to catch every single move, and you don't need to be successful in the market. Once you have those 4 criteria, and I think you understand them, the second thing, or number 5 here, I think what you need to understand is that you have to accept that it's not one single trade. Don't put a trade on and think that it's do or die based on this one trade. You have to do 20 to 30 trades of a specific trade setup before you can evaluate whether you're doing well or not. And you need to follow your plan. It's very important to accept that, you're not going to take a win. You're not going to have a win every single time you do a trade. Once you can do 20 to 30 trades successfully and using the exact same approach and the consistency in the approach, and you have a specific method that you're using, then you can go to number 6 and add a different approach or a different methodology into your equation. And I think once you do that, then you're able to make money in all different types of market environments. The pattern that I'm showing, where you're looking for this strong move to the upside and then a pullback, happens in all different time frames every single day. But if you're only looking at daily charts or weekly charts, you're not going to have them show up every single day. You'd have to look at different time frames to be able to see them. So anyway, I hope this was helpful. Please hit the subscribe button. Give me the thumbs up, and we'll talk to you soon.